If there's one thing we'd like to impress on you more than any other, it's the importance of diversification. More than 60 years of academic research has consistently confirmed two key benefits. On the one hand, having a diversified investment portfolio reduces your exposure to different types of investment risks. On the other, it can also improve your expected returns. We all know the old adage about not putting all your eggs in one basket, and it's a helpful analogy for investors. But as well as having multiple baskets, you need to ensure they're stocked with not only eggs, but a bounty of fruits, vegetables, grains, meats, and cheese. Just as overexposure to one type of food can be detrimental to our physical health, failing to diversify your investments increases your vulnerability to company-specific, country, and investment-style risks, creates a bumpier investment experience, and makes you susceptible to second-guessing your investment decisions. In turn, these can cause unnecessary costs, lower returns, and increased anxiety. There are carefully designed funds available today that offer efficient, low-cost exposure to capital markets all around the world. Investing in a wide range of such funds is the best way to capture the full benefits that global diversification has to offer. Let's take a closer look at managing risk, which is one of the main reasons for diversification. Perhaps the most obvious risk is the risk of being too concentrated. Even in a bull market, the price of an individual stock can plummet. And when the wider economy is thriving, a corporation can still default on a bond. You can avoid concentration risk by having a diversified portfolio. While it is possible to diversify concentration risk, market risk, on the other hand, can't be diversified away. And for that reason, it's reasonable to expect to be compensated for taking market risk, but not for taking concentration risk. That doesn't mean that taking market risk is easy. However, those who stay invested when market risks are on the rise can expect to be compensated with higher returns as the risks ebb. But in the short run, they have to endure market fluctuations that can test the resolve of any long-term plan. That's why you want to take on as much, but no more, market risk than necessary. Diversification becomes a dial for reflecting the right amount of market risk exposure to best meet your individual financial goals. So, whether we're talking about concentrated or market risks, diversification plays a key role. But there's another important benefit to consider, and it's this: staying diversified will create a smoother ride towards your goals. Like a bucking bronco, short-term market returns are characterized more by periods of wild volatility than by a steady-as-she-goes trot. Diversification can help tame the bronco. Imagine 3 jagged, upwardly mobile lines, representing different kinds of holdings. Individually, each represents a bumpy ride. Bundled together, the positive trend, by and large, remains, but the peaks and valleys are much less pronounced. One of the reasons for this is that when one type of investment zigs, another often zags. So when some of your holdings are underperforming, chances are that others will outperform, or at least hold their own. Diversification thus provides a coherent, cost-effective strategy for managing desired outcomes that removes the need for guesswork. A helpful illustration is the periodic table of investment returns, a color-coded layout of which market factors have been the winners and losers in past years. The only discernible pattern is that there is none. If you can predict how each column of best and worst performers will stack up in years to come, your psychic powers are greater than ours. So, the benefits of diversification are clear to see. How you start to build a diversified portfolio that's right for you is the subject of our third video.